Bismillahirrahmanirrahim. Assalamu alaikum everyone. My name is Yasir Yamin and I welcome you all in this session. Guys, in today's session we'll be doing ACCA's pre-March 2025 mock examination on the paper financial reporting, which is FR. Alright. And the particular CRQ we are doing in this particular session pertains to the topic of ratios. Now I truly understand ratios as one area where almost every student is not 100% comfortable. At least in your mind you are not comfortable. As far as I am concerned, I certainly believe, I have always believed, not now, but I have always believed that ratio is one topic, interpretation of financial statements is one topic that always gives you very good marks. I haven't seen any student who works hard, who tries to write an answer and who tries to complete the whole question score bad in ratios. Okay, that's fine. You can make one or two mistakes. That's fine. That is acceptable. But largely speaking, everybody is always on the right track as far as interpretation of financial statements is concerned. But there is always fear of unknown. Because interpretation of financial statements is one area where you are not expected to give a learned answer. So you always need to create something of your own. And if you're always expected to create something of your own, that gives you some sort of anxiety which you need to get relieved of as soon as possible. Because in your exam, if you go with the perspective that you won't be able to do it, certainly you won't be able to do it. And if you have this thing in your mind that no matter what happens, ratios is one area that Sir Yasir said everybody scores well in, you will definitely score well. You will definitely score well. I have no doubts about it. Alright. So be confident about this particular area. Alright. So let's begin, guys. Let's begin. We'll start attempting this question and I'll need your feedback as we do solve this question. We will be solving this question on an impromptu basis. So technically, I don't expect you to be prepared for this. I expect you to be random. I expect you to utilize your existing skill set and existing knowledge and provide whatever you infer from the question. Whatever you infer from the question. I do not expect you to exactly comply with what your examiner has provided as an answer. Whatever you provide as an answer, it must have a clear rationale behind it. And if you have a clear rationale behind it, it is at the very least acceptable to me. And most likely it will also be acceptable to your examiner. Right? So let's begin. So this is a 20-mark question, by the way. I mean, you can see the requirement as a starter. This is a 20-mark question which comes on interpretation of financial statements in your paper. Now, these 20 marks have been divided into two areas, part A and part B. Part A is for 8 marks, which is roughly 40% of the total marks that can be awarded for this question. And the rest 60 marks pertain to part B. Let me go through part A, the requirement first. So if you see the requirement A, which is 40% of your examination question, this gives you calculate the ratios for super goods company for the year ended 30th September 2023 equivalent to those shown for the sector average. So, in the question there might be some data available which is related to the sector average and you need to, calculate comparable ratios. You need to calculate comparable ratios. And then most likely in part number B, examiner says that using the ratios calculated in part A above and the information given, you need to analyze the financial performance and position of super goods company. Your answer should include a discussion on any additional information that is necessary to obtain better insights to analysis. So anything which you don't find into the question, but you feel that if it would have been provided, you could have come up to a better conclusion, then you can talk about that as well. You can discuss that area as well. So clearly, requirement number A is a pure calculative requirement and requirement number B is a pure analysis requirement, and it's a pure theoretical requirement as per se. All right. So now let's go through the question. One thing that you should always remember whenever you are attempting interpretation of financial statements question is that you should plan to read the question very slow. You should plan to read the question very slow. If you are attempting this ratios question as a last question of your examination, I wish, and you should also wish, you should also try that you leave some extra buffer time in attempting this question. If you have, let's say, 5 or 10 minutes more than the targeted time for solving this question, most likely you will read the question slow. And if you read the question slow, you will definitely be in a better position to answer. So you read the question slow and answer it fast. That's a standard strategy I've always told you about this paper whenever you are attempting this paper. Alright, so we'll apply the same philosophy here. Examiner says, there is super goods company. Super goods company is engaged in manufacturing of home appliances, which it distributes through a network of dealers and departmental stores throughout the country of Zealandia. So super goods company is a company which sells home appliances. Home appliances would include like I don't know, like washing machine, toasters, sandwich makers. I think these are home appliances, right? And they sell these home appliances. They distribute this through a network of dealers and maybe some departmental stores. So when you talk about dealers, these are wholesalers, makes sense? And when you talk about direct departmental stores, these are against these may be your end customers, these may be your retailers who eventually finally sell off the product, right? And the country is Zealandia. Examiner says the market for home appliances is very competitive. Always note down such key attributes or adjectives or adverbs that are given into the question regarding the scenario. So examiner is saying that the market for home appliances is very competitive, right? So competitive means that everybody is bargaining on the price. So you don't have the liberty to charge your own set of prices because everybody is trying to sell based on penetration, and therefore you will never have the opportunity to to provide for your own price, to dictate your own price. That is what competitive means. Examiner says the following data shows some of the key ratios for the home appliance industry. So you have been given with sector averages as far as GP margin is concerned, and please note down these ratios because I would expect that as we move forward into the question, these are the ratios that you need to calculate for super goods company as you read in requirement number A. So I would expect that while I'm reading the question with you guys, you are fast enough to also simultaneously, you listen to me, but you also start calculating these ratios, right? So gross profit margin, the sector average is 45%. The operating profit margin for the sector is about 17%. So on an average, people who are in this home appliances industry on an average operate on a 17% operating profit margin. So this is an industry standard, right? It's an industry average. So some people earn more than 17 if they optimize their cost and they charge their margins accordingly. And some people might earn less than 17 and the whole sector average is about 17. So if you are earning less than 17, then you are amongst the less competitive companies, and if you are earning more than 17, you are one of the more competitive companies in this space. Examiner is saying interest cover, the sector average is about 8.3. Is 8.3 a good interest cover? Is 8.3 a good interest cover? 8.3 basically means that companies on an average earn enough operating profit that they can pay the same interest 8.3 times from their existing level of profits. Is this good generally speaking or not? What would you guys say? Is 8.3 a good interest cover? Yes. Now, why did I stop you here? Because when you are reading the question, if you do not infer this from the data, then you are mistaken. I've seen many students who will be reading the question like, okay, gross profit margin 45%, okay, and you're lost. You don't get feel of the question. If you're not reading the question in a manner in which the question starts talking to you, you're mistaken. You will never score good in this paper. You will never score good in any paper. So please make sure that you talk to the financials that are given in front of you. So gearing, debt over equity is 40%. So the sector as a whole is not highly geared as compared to equity. So since it's not highly geared, it's possible that the industry operates on an 8.3 times interest cover. The only reason you might have a sufficient interest cover is that you hold less debt. Since you have less debt as a sector average, you have the ability to pay 8.3 times interest within the same level of profits, which is a good sign. Current ratio of the industry is 1.75:1, which is again good, relatively good as compared to what benchmarks we've studied in our theoretical classrooms. Inventory holding period on a sector average basis is 45 days. Receivable collection period is around 25 days. And return on capital employed on a sector average basis is 29.4%. So anybody who invests some sort of capital in this particular industry, on an average, investors would expect a return of about 30%, and then only this investment becomes viable, right? Now, if you move on, you have been given some extract of financial statements of Super Goods Company for the year ended 30th September X3. You have been given that Super Goods Company has earned a revenue of $120,000 during this period. Cost of sales were $78,000, and that meant there would be a gross profit of $42,000. Pretty easy for you. You can do 42,000 divided by 120,000, and there you will have a GP margin, right? Now, operating expenses are 28,800, and that leaves you with a meager profit of operating profit of 13,200. Then you have to pay some sort of finance cost for the company. That means if you're paying finance cost, you will have debt in your financial statements. You won't be paying financial cost if you don't have debt or you don't have overdraft. Certainly that would be there. That's why you're paying finance cost. Profit before taxation is about 10250. Taxation is about 2050, around 20%, I would say. And then profit for the year is 8200 finally. So certainly the company is profitable. You are left with a positive bottom line. Make sense? If a company is profitable, should a shareholder or any finance provider or any reviewer, should they be concerned from any respect? The company is earning a profit at the end of the day. Should you be concerned? Or you should say, okay, as far as we are earning a profit, it doesn't matter. You see, the point is you are earning a profit of 8,200, but on a sales level of 120,000, right? As far as operating profit is concerned, you earn a profit of 13,200, but on a sale of 120,000 level. So, you see, technically speaking, as far as the company is profitable, there is no immediate urgency, right? Because the company is not making loss, it's making profit. But from an investor's perspective, from a finance provider perspective, they have employed some capital into the business. And they would always want a return which is industry competitive, right? So you would want a return on capital employed close about of the sector average, 29.4%. If you're not earning 29.4%, then this 13,200 or this 8,200 may be meaningless, because as compared to the other industry members, you are earning very less. If you're earning very less, then it doesn't make any sense, right? From an investor's perspective, I would say. Moving forward, statement of financial position you have been provided. Under non-current assets, you have been provided with property, plant and equipment, which is 50,500. But examiner wants you to read note number 1 as well. Then you have been given some intangible assets of 7,500, and examiner again wants you to read note number 2 as well, right? There are some current assets. Current assets include inventories and trade receivables, but I don't see any cash in your current assets. That means liquidity might be a concern for the company. Liquidity might be a concern for the company because I don't see any positive cash here, just money stuck in inventory and receivables. Then you move on with equity and liabilities. The company has some share capital. The company has some revaluation surplus. Now you guys already know what's the impact of revaluation surplus on your ratios. If you have revaluation surplus in your equity, that means that your capital employed would be technically, as compared to book values, your capital employed would be higher. And if your capital employed is higher, consequently your return on capital employed will get lower. So you need to take this aspect into your mind as well. So first, it will increase your capital employed, right? And at the same time, since you might have revalued your assets, it will cause a fall in your profit level due to excess depreciation. Make sense? Make sense? So please do take note of these points. Then you have positive retained earnings of $19,000. You have borrowings in your non-current liabilities of $28,000, and as we guessed it, they have some borrowings and hence there was some finance cost, right? Then your examiner says you have current liabilities, you have trade payables of 15,400, you have overdraft of 16,750. You know, this overdraft is even higher than your trade payables. So that means you are financing yourself through overdraft, not only trade payables but overdraft as well. And you need to think smart. See, if I were you, I would infer this information. You have total current assets of 37,700. Now, the only way you can finance your working capital is either through trade payables or cash. Now, you don't have cash, so you are borrowing money through an overdraft. And the rest you are financing from trade payables. So trade payables, you need to understand this is a free source of finance. The supplier provides you credit against zero finance cost, virtually zero finance cost, right? But an overdraft is always costly. It incurs finance cost, right? So you need to consider this working capital management level as well if you are truly going to analyze this company, right? Then you have current tax liabilities of 2050, then total equity and liabilities of 95,700. Most of the students that I would, encounter would always, what they would do is they would try to skip the P&L and the balance sheet information and directly go onto the notes and directly start solving the requirement. This is the most foolish thing that you can do in the question of interpretation of financial statements. If you're not giving yourself enough time while reading the question, most likely you will be writing a very poor answer. If you're writing a poor answer, then it does not make sense even if you do, if you complete your exam 5 minutes early, because you're not getting any marks for it, right? So please make sure that you leave ample period of time for this particular type of question so that you can solve accordingly. Examiner also wants you to go through these 5 notes which they have provided. So the first note says the property, plant and equipment includes a property acquired by super goods company some years ago. The property has been recently revalued, which has resulted in a revaluation surplus as shown under equity. All right. So there was some revaluation which might have caused your return on capital employed to decrease and your profit. So to decrease and your profit also decrease. As a result, ROS will decrease and profit will also decrease due to excess depreciation. All right. Furthermore, your examiner says the plant and equipment under your property, plant and equipment. The plant and equipment have been in use for many years. And the company is now considering to replace it with modern equipment which would enhance quality and efficiency. So you need to understand, you see, you are in a competitive market and you are in home appliances. Home appliances is rather a technology business. Make sense? And the space is competitive. So primarily in a competitive market, you bargain in terms of price. And when you talk about price is basic, the acceptability of the price is a relative measure in terms of what value your customer gets. So if you have some sort of technological edge from your competitor, let's say you have a fridge which is eco-friendly or which consumes less electricity, now it directly competes with another company which does not have the same feature. Now, you might be able to dictate your own prices if you have high quality, high efficiency products. Make sense? But your examiner just highlighted that the plant and equipment that the company currently has been in use for many years. So technically it's old. Yeah. Anything which is old might also attract, higher maintenance cost. This you need to keep in your mind. And plus, since this is old, this may not be providing you the latest technology or latest superior products. And that is why the company is considering to replace it with modern equipment. When your examiner says the company is trying to replace the existing machinery with modern equipment, then that means that currently you have an older equipment with you. You don't have modern equipment. And older equipment might have led to some sort of inferior products. You can say this. Now, all of this is what I infer from the question. I infer this from the question. Nobody is telling me that. I'm just inferring this from the question, right? Then your examiner says the intangible assets include patents. So we had intangible assets of 7,500 and these include patents. The life of these patents amount to $6.5 million, amounting to $6.5 million would expire in next 2 years. So currently included within your intangible assets, the total value of intangible assets is 7,500. Included within this 7,500 is the major portion of 6,500 which belongs to patents. And these patents will expire in the next 2 years. Now, do you think, I want feedback from you, do you really think the fact that these patents are going to expire in the next 2 years, can this be a concern for the company? Or does this provide us any further information? Does this infer any further information from a business perspective? I mean, just talk about it. You have some patents. Your patents are always on technology, right? In the home appliances sector, you have a patent on technology. And as far as, for the time being that you have a patent, only you can produce a particular good in a particular format of a particular size, shape or technique, in the industry till you have that patent. But what happens when your patent expires? What happens when your patent expires? I mean, let's say, I'll give an example so that you guys wake up and start commenting. Let's say if in the ACCA market only I have the patent to teach ACCA, and I'm saying that the patent to, I have currently the patent to teach ACCA FR paper right now, only I can teach this paper in whole of the world, and let's say that patent is expected to expire in the next 2 months. What is the risk that you would say, Sir Yasir, you would have? What is the risk that I would have once my patent expires? My right to produce something or my right to offer something directly to customers and nobody else can offer. Once that expires, what should be my concern? What is the risk? You're saying loss of customer. Actually, right. You see, loss of customer will be driven from competition. You need to understand. Once you are saying decrease in reputation, but you need to think from a business perspective. So you see, patent actually grants you exclusivity. A patent grants you exclusivity behind a product. So if I have a patent only to teach FR in this whole wide world, what happens when my patent expires? Now you can teach FR, Kamesh can teach FR, any goddamn person can teach FR once my patent expires. So the exclusivity is not there. Till the point I had the exclusivity, I could have charged my own prices. But now, when competition starts to come in, because I don't have, the patent has expired, now other people can pool into. The competition starts to rise and the price war begins. Yeah. So technically speaking, the risk that you would see from an expiring patent is there will be a rise in competition. The industry is already competitive. And there you will see a rise in competition once the patent expires. Once you see the rise in competition, there will be some manufacturers, there will be some companies that will start offering the same product at a lower price, because till that time I would be charging higher prices now because of the exclusivity thing. But once that exclusivity expires and competition starts to come in, they'll start offering the similar kind of a product, maybe manufactured from China or maybe manufactured from a low cost country, and they will start selling the same thing at a reduced price. Make sense? So the margins that I would be earning before would get deteriorated. Make sense? Now, this is the kind of information that you should be extracting from the question. If you're not getting these points as you're reading the question, the most likely thing that the most likely thing is that you're reading the question so fast. And you're not thinking, you're not going within the domains of super goods company. Yeah. Let's move forward. Now, your examiner says the company sells its appliances mainly through the dealer network, which is 80% of the sales on average. The balance would be 20%. The balance 20% comes from retail sales. So what they are trying to say is, you see, you do sales of $120,000 and 80% of these sales comes through dealer network, right? And rest of the 20% comes from the retailer network. By the way, does it really matter that if we are selling 80% of our goods through dealers and only 20% directly to retailers? Does it really make a difference? I mean, you directly go to the retailer or you go via a dealer. Does it make any difference? Alright, so yes, margin, you're right. So dealer provides you reach. That is a plus side. Yeah. So a dealer provides you reach. Areas where you cannot go yourself, your dealer will make sure that your home appliances go in that particular area as well. All parts of the country, maybe all parts of Zealandia. But the downside is, they will get commission on sales. And when they get commission on sales, your net sales, what amount of money that you get, will reduce. And as far as the 20% retail network is concerned, and obviously there will be less margin in dealer sales. But in retail network, you're directly selling to the supermart. If you're directly selling to the supermart, then your margin levels would relatively be higher as compared to when you're selling to a dealer. Make sense? Make sense? Does this make sense? So, this kind of analysis should be in your mind. If it's not in your mind, then again, I'm repeatedly saying that you're mistaking. You're doing it so fast. You're going so fast. And especially on a mock level, if you're going so fast and not understanding a particular company scenario and not preparing yourself on a very fundamental basis, I don't think you'll be able to perform very well in a real exam. All right. Let's move forward. Examiner also says the industry has shifted to retail sales in the recent past. So all of the industry is avoiding the dealer network and they are directly trying to approach the retail stores. With the advent of technology, with the advent of access, with the advent of online sales, with the advent of drop shipping, they are directly targeting the retail sales. This is an industry norm. But you are doing 80%. You are doing 80% of your sales still through dealer network and only 20% through retailer network. Does that really mean that you are behind the industry? Would this statement be correct? Now, all of the industry is moving towards directly to the retailers and you are still with dealer networks. That means you will have low margins. Makes sense. Moving on. The 8% loan notes were issued 3 years ago, alright, and would be due for repayment in 20x5. Now, your accounting year end, if I would go and see, is 30th September 20x3. So, you're in x3 right now, and you'll have to repay a particular loan, and this loan amount is massive 28 million. It will be due for repayment in 20x5, which is in 2 years' time. So if your loan is payable in 2 years' time, what would be a concern for you as a company? What would be a concern for you as a company if your loan is repayable in 2 years' time? You see, a loan can only be paid in cash. So you need liquidity to pay off your loans. But right now, you already saw that you're currently in overdraft. If you're currently in overdraft, you cannot pay off your loan. So within 2 years time, you need to sufficiently manage yourself. You need to earn sufficient amount of money so that you can successfully pay off your loan. And while you also want to spend on a new plant and equipment, you want to spend on a new modern equipment, but then again in 2 years time you also have to pay off your loan. So you need to be mindful of how you are planning your investments and your payback and your cash flow. Make sense? Moving on. Examiner says the company paid dividend of $4.5 million in the current year. Some directors had questioned this propriety of this huge payout that increased the bank overdraft. So some directors are concerned, what's the point of paying a huge $4.5 million dividend when the company is already running on overdraft, and they had to increase their overdrafts due to this huge payout. Is the concern of some other directors correct? Does this make sense? That they are questioning why a dividend payout has been made if the company is already running on overdraft, while they have to pay off their loans in 2 years time, and they also have to invest money in a new modern equipment, and they have an expiring patent, so that will lead to further competitiveness. Does it make sense that they're paying out a huge dividend? I mean, I think no. So this is a cause of concern that would have affected the financial position of the entity, and that would certainly give rise to questions on the future financial performance anticipated from the company, right? So all of these points we have read. Now the first thing that I would want you to do is help me calculate 8 marks worth ratios. So can anybody calculated these ratios yet? If yes, please start telling me those. Anybody calculated gross profit margin? So gross profit margin of super goods company you're saying is 35%. Yeah, this is GP divided by sales. 42,000 divided by 120,000 multiplied by 100. What about operating profit margin? This is 13,200 divided by 120,000 multiplied by 100, 11%. So I can literally see that gross profit margin and operating profit margin of super goods company is relatively less as compared to the sector average. Did anybody calculate interest cover? Interest cover, the formula for interest cover is PBIT, which is operating profit divided by finance cost. So 13,200 divided by 2950. Has anybody calculated that? I expected that you would have calculated ratios by now. You don't need to wait for me so that you can calculate ratios. You should be quick enough. While you're reading the question, you should be solving it on your own. Want me to calculate it by myself? Okay, somebody has done it already. 4.5 times, I would say. What about gearing ratio? Debt over equity. So can anybody calculate debt over equity? Let's see who does this first. Certainly I can do it faster than you. I've already done it. It's about 84%. Can anybody confirm this answer? So the debt level is 28,000 and you divide it by total equity, which is 33,500. 28 divided by 33,500, it's 83.5 or 84%. Current ratio, the next ratio is current ratio, current assets divided by current liabilities. Let's see, who can do this first, me or you. 37,700 divided by 34,200. It is 1.1. And mashallah, your speed is very less as compared to me. Yeah. Then inventory holding period and receivables collection period. Inventory holding period. So inventory 20,200 divided by cost of sales, which is 78,000, multiplied by 365. This is about 95 days. As far as the receivable collection period is concerned, our receivable value is 17,500. Our sales value is 120,000. 17,500 divided by 120,000 multiplied by 365. This is about 53 days. Return on capital employed, PBIT divided by capital employed. So the PBIT is basically your operating profit. So 13,200 divided by your capital employed. Your capital employed is your equity plus debt, long-term debt. So 33,500 plus 28,000. This is 21.4% for me. 21.4% for me. Let me know if all of these numbers are correct. Let me know if all of these numbers are correct. Please check these numbers. All good? So I'm taking my time explaining you this question because before exam, I really want you to be, to be very much comfortable with the whole process. I can do it faster. I can keep on telling this to you. But again, I want you to feel comfortable around this ratios question. That's my target. Is everybody on the same page? Now, if everybody is on the same page, then let me read the requirement. The requirement is using the ratios calculated in A above and the information giving, analyze the financial performance and financial position of super goods company. Analyze the financial performance and financial position of super goods company. We need to talk about financial performance and financial position. So let's start with financial performance. Can you guys start telling me some pointers? I'll make those pointers. Don't worry about that. I'll make those pointers. I'll write those pointers here for everybody. But let's begin with the analysis, right? When you talk about financial performance, let's start with gross profit margin. Why don't we? So the sector average gross profit margin is 45% and you have a gross profit margin of 35%. So technically you can say that super goods company has lower GP margin as compared to the sector average. Agreed. But what's the reason? Now start telling me what can be the potential reasons or what can be the underlying causes that our GP margin is not as good as the sector average. It doesn't make sense now. Everybody is selling at a certain price, but you're not able to sell at that price. You're earning less gross profit margin. What can be the reasons? Okay, so the first point that you make is that SG company is 80% dependent on dealer sales and that would lead to lower net sales meaning after commission, so lower GPM. Any other reasons, any other thing that you would analyze from the question? Is one point enough? If one point is enough, then you're truly not analyzing the whole situation properly. So one other point comes, sir, older machinery. The company currently relies on an older and non-modern equipment which would have led to inferior quality and efficiency products, hence the price challenge. Any other thing? Any other thing? You're not talking about the competitiveness of the market, right? The market is competitive anyway. So it might have been difficult for the company to generate sales and hence the lower GPM. Yeah. Any other point? I mean, there are so many points that you can comment here, but I am only getting limited responses. That's not good. Any other point? I'm just wishing that you guys would, be smart enough and gather points like anything. I mean, what about the expiring patents? Expiring patents in future would lead to more competition, and once they lead to more competition, lower GPM in future. I mean, I'm just noting down the points now due to limited space. You need to draft a proper answer yourself. Does this make sense? So you see, only for GPM you have a lot of information available. I could have gone through anything. And remember, you also need to think that your examiner said your answer should include a discussion on any additional information that is necessary to obtain a better insight into the analysis. You need to talk about any other information that if that information would have been provided to you, you could have written a better answer. For example, let me give you a pointer. If you would have been given further data on the margin levels charged from dealer sales and dealer and retailer sales, a better analysis could have been done. Or maybe somebody could say that if we had been provided data regarding product sales to which the patent relates to, we could have reached to a better conclusion. Let's say, your analysis would be different, na? If you were to get this information that let's say 60% of the product sold relates to the patent which is going to expire in the next 2 years, then you will be concerned a lot, because once that patent expires, 60% of your sales will be exposed to new competition. They will challenge the status quo. They will start producing the similar type of a product, maybe and offer it maybe at a cheaper price. They'll get it manufactured from China. Yeah. And for example, if you would get to know this information that the product which is patented only offers you a 6% total sale contribution, then you might not be worried so much. That point you could have written. Yeah. Yes or no? So there are many points that you could have addressed just in gross profit margin. Remember, gross profit margin is the primary indicator of product profitability. And once you are talking about this home appliances industry and you're talking about competition and you're talking about newcomers coming into the business, you're talking about older machinery being replaced and patent being expired, everything is circling around the product. If you're not very well conversed with the product itself, if you're not very well conversed with the business profit, the product profitability itself, then you will not be writing a better answer. I cannot find one person who could have written more in OP margin and less in GP margin in this particular case. Because in such type of a business, everything is driven from sales, from the product. So you need to talk more about GP margin. Yeah. Now, okay, let's move forward and let's talk about OP margin. So I understand that sector average gross profit margin is 45%, but super goods company is only earning 35%. So this is 10 basis point, this is 10% lower as compared to the sector average, and your shareholders would not be happy about it. But what about your operating profit margin? The operating profit margin, the sector average is about 17%, and your operating profit margin is only 11%. So first things first, OP margin, I can write it down here. OP margin is less than the sector. Understood. But any other topic that you would want to highlight? Your OP margin is less than the sector average. So first point is, okay, there is impact of GP margin, makes sense. So lower GPM leads to lower OPM, makes sense. At the same time, you see, if I were you, somebody said, sir, poor cost control. This is, yes, one of the items that you would always say when you're talking about a lower OPM. But you see, my analysis is a bit different. The gap between gross profit margin of the sector and us was 10%. The sector was earning 45% GPM, we were earning 35% GPM. So we were 10% lower than the industry. But on an OPM level, we only have a distance of about 6%. So the distance has reduced when we talk about OPM. So I would say that there might be some positive signs too. The company might have started taking some cost control actions, and due to that, the difference between their OPM levels might have reduced. Can this be a reason? You tell me, guys, can this be a reason? Maybe yes. And then there would certainly be issues of excess depreciation due to revaluation. By the way, somebody could have written poor cost control. You could have written poor cost control. This is a generic comment whenever you see less operating profit margin. And maybe Avinash, you could have said that the company needs to apply better cost control. That is fine too. But from an analytical perspective, I see that the gap between profits is reducing when you come to OPM, and that is why I said this point. Your point would also have some sort of weightage. Don't worry about it, right? So excess depreciation would also be a concern for the company due to revaluation. Might also have impacted OPM, operating profit margin. Is there any other point? You need to answer me yes or no. Is there any other point that you would want to highlight when you're comparing operating profit margin of the sector average and super goods company? So this is the area that you're talking on about the P&L. Is there anything else that you would want to comment? You would want to comment on what further information could have helped in your analysis. Again, this is a generalized comment that you would say, and your examiner is asking you for any further information that you would want in making your analysis better. So maybe you would need a breakup of your operating expenses now. And that is the only way that you can identify if there are any one-off cost or not, if there has been any impairment or any one-off maintenance cost due to an older plant and machinery. One point is, older plant and machinery could have led to unexpected maintenance cost maybe. If I were you, I would certainly write that a breakup of operating expenses would have further helped in a DU analysis. Make sense? Now you're talking so now what we'll be doing is, under financial performance, what we should be doing next is, I think we should be talking about any other ratio that talks about the performance. We can talk about return on capital employed, right? So if you talk about return on capital employed, your return on capital employed is, the sector average is about 29.4% and you have a return on capital employed of about 21.4%. Anything that you would want to say regarding return on capital employed? Please, I want your comments. Guys, I could have written an answer, with my eyes closed in half the time that you could have written. The only reason I'm here is to help you develop this understanding and develop this ability to gather out some points. And you can be wrong, that's fine, but I am there to help you correct your understanding. Yeah. So one topic that you said was revaluation. So ROS is lower than industry, right? Probable reason can be revaluation. Would this be satisfactory for your investors if your return on capital employed is less than your industry average? Your sector average is 29.4%, about 30%, and you're only earning 21%. So would your investors be happy about it? High gearing is not one of the reasons. Yeah. So if there is high gearing, you utilize that money in order to generate a higher profit. That doesn't make any sense. Yeah. So high gearing is not a problem, right? When you talk about return on capital employed, you talk about the returns on those capital employed. Yeah. So talk about it. Revaluation can be a reason, as it would have overstated capital employed. Would this be satisfactory for your investors? Would be a concern for investors regarding utilization of their provided capital. I mean, just imagine the faces of your investors. Everybody, if you take sector as a whole, everybody is earning at least 30%, return on their capital employed. And as super goods company, you are providing a return of about 21% on the investment that your investors would have done. Would they be happy? They would be highly concerned about your performance, right? So, investors, when they see that you only earn 21% return on capital employed as compared to a sector average of about 30%, would they be willing to give you more money? Would they be willing to give you more money? Would you have face to go in front of your investors and ask for more money? No. I mean, you have plans, the company has plans for further investment. And certainly they don't have cash. So if they don't have cash, they would need to generate finance. this would require fresh capital. Do you think it would be very easy to raise this fresh capital? Arranging loans might be difficult because you already have to pay off a loan of $28,000 in 2 years' time. Most likely you would have to rely on your equity holders. Now, despite the fact that you have given a huge payout of $4.5 million to your shareholders, that was written in this 0.5. But again, overall, the return that you're generating on investors' money, would they be willing to give you this money for very, at a very cheap price? Would they be willing to give you more money? Maybe a concern. This may be a big concern regarding companies' future plan. Make sense? So this is all what you could have talked about when you're talking about ROS. And the list can go on. I'm 110% sure that you can write a better answer than what I have written. I have no doubts on your capability. But I think this is the basic, this is the least that you could have pointed out while you have read the question. Don't you agree? Don't you agree? Guys, please give me your feedback. The only thing that I'm concerned about is your performance. And that your performance only depends on the understanding that you take in your examination. This is all what has been written into the case. If you have read the question clearly, then this is all what is already there in the question. I'm just repeating it. This comes naturally to me. I'm not preparing for it. I don't have to read any books or study text or watch any lectures for it. This is pure common sense based on the knowledge, based on the pre-knowledge that you have already obtained from the lectures. Rest is your common sense and your accountancy mind that would help you in inferring these points. Yeah. Can you give me some points? And now I would only need some points. Can you talk about something on gearing? Now we'll talk about something on financial position. Super goods companies' gearing is almost double to that of sector average. And if you have double gearing, obviously your interest cover might not be as well as compared to the sector average. Definitely, since your gearing is double, your interest cover is half. Make sense? Although you have an interest cover of 4.5 times, and theoretically speaking, 4.5 times of interest cover means that you are still sustainable. You can pay the same amount of interest in same amount of profit levels 4.5 times. But from a financial risk perspective, from an investor's perspective, would your investors be concerned about this performance? Because any company that they see in the market, they have a sector average interest cover of 8.3 times and you have a 4.5 times. So this may be alarming for investors. This may be alarming for lenders as well. This may be giving a hint that something is going south. And maybe in future years, when your patent expires, when you're not able to pull off investment for a new machinery, if you have higher competition levels, then your margin levels will further deteriorate. And if they further deteriorate, this interest cover might not be sustainable enough. The less interest cover is already hinting that there is a problem. And this problem could aggravate in the upcoming years. Do you all agree with this analysis? Guys, do you all agree with this analysis? Yeah. And then let's start talking about, the liquidity perspective, right? So the liquidity perspective, definitely our current ratio is much less as compared to the sector average. But the question is, where is your money going? I mean, you have high gearing ratio, so you are financing yourself through debts, but where is the money going? And you can clearly see that your money is stuck in inventory and your receivables. Your money is stuck in your inventory and receivables. You have very high inventory days, and those high inventory days might be due to falling sales level. This is an alarming position. So you're holding double time inventory period as compared to the sector average. You are certainly seeing some problems generating sales. And that, this also corresponds to the lower gross profit margin that you have. And furthermore, your dealers may be exploiting you certainly. The money that is stuck into your dealer network is about 53 days. You have 80% sales coming from dealer networks. Your entire sector has directly moved on to retailers. Now, retailers might be giving you early money as compared to dealer network. This is clearly a poor working capital management scenario from a company's perspective. Why are you not shifting to retailers? Why are you allowing such a credit period to your to your dealers? Maybe due to falling sales, maybe due to inferior product. But certainly this is certainly not helping the company. Can anybody also calculate the payable days? We have this trade payable information given 15,400. So I'll take 15,400 divided by cost of sales of 78,000. Can you guys tell me what is the payable days? What is the payable days? 20. Are you sure 20? It's not 20. It's 72. Okay. 72 days. So you have inventory days. Let's talk about the cash operating cycle now. The inventory days is 95. The inventory days is 95. The receivable days is about 53, and that the total of this should be 95 plus 53. 95 plus 53 is 148. So for 148 days, your money is stuck already in inventory and receivables. And you are paying off your suppliers within 72 days. So you are paying your suppliers earlier than you recover the money from inventory and receivables. And that means you have a positive working cycle. You have a positive working cycle, cash operating cycle of 76 days. Now, again, I always told you that a positive cash operating cycle infers a negative position. So 76 days of positive cash operating cycle means that this needs to be financed. 76 days, needs to be financed. And this is most likely financed through overdraft, which further dilutes money for shareholder. I mean, you're left with less cash. If you're paying out a lot of interest, you're left with less cash for your shareholders. You cannot pay that money in the form of dividends. It may be a concern for your investors as well, right? And your interest cover is deteriorating. Your gearing is getting higher and higher, maybe, due to all of these poor working capital management actions. This is one area that you can talk about as far as financial management is concerned. Financial position is concerned. Yeah. So does everybody agree on the points that we have discussed? If I were you in an examination and this kind of a question comes, this is a classical question. No consolidation topic here, no cash flow topic here, no merger demerger topic here. This is a classic ratios question in your pre-March 2025 examination. And if this sort of a question comes into your examination, I would really want you to perform very well. Now, believe you me, I tried to do this question on my own. Obviously, I'm a teacher. I have, relatively better expertise than you guys have. But I tried to, do this question by myself within the stipulated time without even referring to the examiner's answer. And this is what I have written. I tried to do this within the stipulated time. I did all of the calculations within the stipulated time, and then I wrote an answer. And remember guys, I've written this answer considering that if I was sitting in the examination, or on your behalf. If I was sitting there, I would have written an answer like this one, and I did not see the answer of examiner till that time. And when after writing this answer, when I compared my answer to the answer of examiner, there were some points that examiner mentioned that were in addition to what I have written. So, your examiner gets plus point there. But there are some critical points that I have mentioned that your examiner did not mention. And thereon, I will get some positive points as well. So, this is the approach that you need to take whenever you're practicing for anything. You do not need to think as if that you need to write exactly as your examiner has done in its suggested solution. That's not the idea. You need to write an answer on your own and then assess if that answer is worthwhile or not. I'll read this answer which I have written for you, and I'll be sharing these notes for you if you want. I will be reviewing this answer with you guys, and you guys tell me if you guys would have written an answer obviously better than what I have written. I trust your skills. You will definitely be writing a better answer than what I have written. I have full confidence on you, but let's read it together. So how I started the writing an answer from the perspective of a student, not from the perspective of a teacher. So I started talking about the financial performance. I started talking about gross profit margin. So in my mind, it was there, the market is competitive. I'm in the home appliances industry. My patent is about to expire. So the whole situation revolves around the product. So I need to talk more about the product. It's not about managing the business correctly. It's about the product. If the product does not have enough contention, if the product does not have enough appeal, doesn't matter how well you manage your business is going to go south, because the product does not have enough ability for sale, right? So I started like gross profit margin is the primary indicator of product profitability. In the case of super goods company, gross profit margin is substantially lower than the industry average. So I was trying to set the tone of my answer. While first talking about that, if the performance of super goods company on the face of it is better than the sector average or not, I try to, set this tone towards the start. So I get my mind fresh, This would suggest that the company is facing the heat of highly competitive market of home appliances and may be offering substantial discount to sustain sales. This is one area that we already talked about earlier. However, a deeper review identifies that 80% of their sales are based on dealer networks, which would be a cause of lower net sales, net of dealer commission. If further information would have been available for retail sales and dealer sales margin, then a better comparison could have been made as the industry shifted towards retail sales. So the entire industry is shifting towards retail sales. You are still there with dealer sales, and that certainly would have led to lower margin levels with you. Dependency on dealer networks would mean that the cash gets long stuck within the value chain, hence higher receivable days than the sector average. I tried to link this from the receivable days as well. The company also plans to modernize its equipment to improve quality and efficiency. This suggests that the current product models may be technologically inferior to competitors, which may be the reason for less GPM. A further concern would be the expiring patents, as its expiry might attract new competitors who might challenge the status quo with lower prices. It is not evident if the company is spending any amounts on research and development, so future outlook does not seem appealing. Operating profit margin is also lower than the sector average, but relatively less gap compared to differences between GPM. This suggests that overall operating expenses may be well under control. If you would see this area of your examiner has gone in another direction. Your examiner is saying that since operating profit margin is lower than the sector average, there might be poor cost control, as Avinash also mentioned. But this is my perspective of writing, so I don't need to align my thoughts with the examiner. I just need to provide enough evidence, enough rationale behind what I'm writing. Furthermore, revaluation on PPE done several years ago would have led to increased depreciation, hence corresponding to a lower OPM. Also, maintenance cost needs to be investigated as the company operates an older plant. A breakup of operating expenses and their benchmarks could have helped in the thorough analysis had this information been available. You always need to discuss any area, any further information that if provided to you would have led to a better conclusion. Examiner says, oh sorry, I wrote overall ROCEs compared, lower compared to sector average, which may be a concern for capital providers. If revaluation is offset, then ROCE would be 25%. I tried to offset the revaluation and then see if my ROCE would be sufficient enough, but that was still lower than the sector average. Yeah, so somebody told me that, sir, one of the point of lower ROCE can be revaluation. So why don't you work out revaluation, remove revaluation, and then see how your return on capital employed performs. My return on capital employed was 25% even after deducting revaluation reserve from the equity, but still the industry benchmark was 29.4%. So it's still lower than the sector average. Yeah. Financial position. Financial position may be a bigger concern here. Gearing of the company is higher than double of the sector average, though interest cover of 4.5 times might suggest no immediate concern, but from a financial risk perspective, it still cannot be ignored. Given that the loan will be repayable in 2 years' time and the company is running out or running on an overdraft, lenders will be concerned about it. Likewise, directors concerned about a huge payout of $4.5 million under such circumstances is correct and will further add to the risk of lenders. I mean, you have to pay off your loan in 2 years' time. You're already short on cash. You're running on overdraft. And during this time, you are actually paying off money to your equity holders. Definitely, it will be a concern for your debt holders. They'll be looking at all of this. And they'll be saying, okay, you're playing with our money. You have taken our money and then you're, reimbursing this money to your shareholders. This might not be acceptable to them. It should be noted that the company intends to invest in new plant and machinery which would require further capital. Under such circumstances, borrowing will be difficult and the directors will have to rely on shareholders for capital injection. Given lower than sector ROCE, this will not be an easy bargain raising capital with shareholders. Further analysis also reveals that company is inefficient in managing its working capital effectively. Its inventory and receivables holding period are nearly twice the industry average, so a lot of cash is stuck in working capital. Its payable days are 72, as you guys told me, which are well below the sum of inventory and receivable days. Higher inventory and receivable days also pose a risk of inventory obsolescence and bad debts respectively, which could dilute the profitability in years to come. Similar conclusion can be drawn by the lower current ratio of 1.1 against a sector average of 1.75 times. You must be writing a conclusion in such sort of questions. Overall, the company's financial performance and position both are relatively weak compared to sector averages. Debt burden and the loan due in 2 years' time should be an immediate concern for investors and other stakeholders. Expiring patent will also adversely affect the financials given the competitive market, and that is all from my side. So, do you think this is a decent answer? Given that you will be writing a better answer than what I have written, do you think this is a decent answer? I want you to write a better answer. When you go in your exam, I want you to write a much better answer than how I can write. I have full confidence on you and you can write it. I'll offer you something more. Maybe what you can do is, for ratios topic in particular, you write some answers, send it to me and I'll review it for you. I'll send you a short voice note, telling you that how did you perform. But try to, provide me an answer on a word copy and try to use a bigger font so that I can read it quickly and provide you a quicker feedback. The more practice of ratios topic that you do before going into your exam, ultimately that will favor you once you go into your exam. So work hard, and I want you to ace this exam. Clear?